Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I provide online divorce mediation and valuation services in St. Louis, Missouri. Today, we will discuss business valuations and changes in the IRS for 2022 with a former IRS auditor, Mike Gregory. Mike Gregory is the founder and owner of Mike Gregory Consulting, LLC. He brings 28 years of experience with the IRS in a variety of capacities. During his last 11 years with the IRS, he was an IRS territory manager with responsibilities for up to 23 states, with an emphasis in business valuation and specialist issues nationally. He's also was involved with creating and talking to the IRS about the discounts for lack of marketability and also reasonable compensation. The other book that he has written is called The Collaboration Effect, which basically brings together neuroscience and kind of negotiation techniques in order for you to work with the IRS if you needed to in some capacity. We've kind of said, like, is this necessary? Well, the interesting part is I also, so I've never had this happen, right? I've never had a valuation that I've done be audited or looked at that I know of, right? So can you even, before we even answer, is the IDR necessary? Because I think it's actually beneficial for the person, because they've identified what they need. Is the IRS always going to ask for this? Are they always giving us a document request?
No. I also want to comment that generally, you as the appraiser don't even know you're being audited. Your client is the estate. The estate's being audited. The estate tax attorney, for example, is working with the IRS. That person may be working with me. I might be providing information before the return is filed. I might be providing information on how to work with the IRS. I would say 9 times out of 10, you don't even know what's happening. And they're also making decisions on your appraisal with what they're going to concede, and you don't even know what's happening unless you have an engagement letter that says, if this return were to be audited, you need to let me know within 10 days. If the return is being audited and it's any questions are on my appraisal, you need to let me know within 10 days. Because no offense, but your client can throw you under the bus and say all kinds of stuff, and you don't even know that's happening. So you might want to be there to be able to defend yourself with the IRS. Now, I ran a litigation group. I grew a group from 9 people to 21 technical people over 3 years, and I managed the group for 7 years. We had up to 10 to 12 cases docketed at any one given time. And only about 10% of those ever made its way actually going into court. And many of those were actually settled on the courthouse steps, so to speak, the day of trial. Having said that, I'm coming back and saying very few of these cases ever make their way to court. They get settled well beforehand. They are resolved on exam. They're settled based on the hazards of litigation and appeals, or they're with counsel and they get settled before they actually go to court. Now, that all having been said, what I found is on exam, if you spent X amount of time writing a report for exam, when you go to trial, I hate rules of thumb. Got to say it up front. Rules of thumb, they're all over the place. But as a rule of thumb, I found that if we spent X amount of hours on the initial report, when the case goes to court, we're going to spend at least 5X. Wow. Because we leave no stone unturned. When you said when you looked at a data set, you said I took this from Done Deals or whatever. You have a bunch of comps in there. We go back and actually check every one of those. And when you compare that with another data set, let's say BizComps or something, when you come in and look at other data sets, are they duplicates? Do they have the exact same numbers in there? Why not? Sometimes they have information in there twice. It's not correct. We want to make sure everything we have is right. If you're going to court, you don't want to have somebody bring up something that I don't know why that is what it is. You want to look like a very competent expert. So a lot more time is spent if you're going to court. So I'm looking at your report that you prepared for exam. You might have thought, well, if I was going to state court, that's fine for state court. I'm going to tell you it's probably not fine for federal court. Mm-hmm. For federal court, you're going to need to spend a lot more time. And in fact, generally, new reports are presented about 32 days before you actually go to court. Because the report that I wrote 3 years ago, am I still doing things the same way today? Probably not. Rule 702 says I'm writing the most comprehensive report to to help that decision maker, the trier of fact, make a decision. So I'm actually going to write a new report. Is my number going to be the same? No. My number is going to be whatever it is. So I had what, oftentimes you see, this is what they had on their return, and then this is what they had at trial. That's a whole new report. I mean, you used a lot of the same information, but you dug a lot deeper if you're going to court to get a new report. You have to exchange these 30 days before you go to trial, but there's a weekend in there, so that's why I say 32 days. So anyway, minimum. And sometimes on working with the IRS, taxpayers will come up, this is my appraisal, this is what we're going to do. You're working on this, you're negotiating on that. You think you're getting ready for trial, then all of a sudden, 32 days before trial, you say, by the way, here's my new appraiser, here's this new report, and here's what they're going to present going into court. So on the IRS side, it's like, okay, we got a whole new way of trying to address this with this new appraisal or second appraisal or more than one appraiser coming in. So there are a lot of different variables that enter into this.
Well, and from what you're talking about, though, the more you don't treat it, so just walk me through, like, what happens if they flag a valuation? Are they then just sending something to the client, like that it's deficient, and that's what triggers all of this to happen? Because it seems like if you're just looking at it as, okay, we did the report and now the IRS has an issue and we're going to go to court.
Oh, no,
There's
no.
a whole bunch, like
What?
this could be resolved with some negotiating closer to when it first starts, right?
There are three different elements: exam,
Okay.
appeals, and collection.
Okay.
And on exam, they're just trying to obtain the facts and see if they can resolve this on exam. And for a cooperative taxpayer who works reasonably with the taxpayer or works reasonably with the IRS, a very high percentage, maybe 85, 90% are resolved on exam. I don't have a number, but something very high percentage. Those are resolved on exam. And you may have questions beyond the initial report. That's the information document request. That's where oftentimes your client, that estate tax attorney, is answering these questions, which they should have gone to you to get an answer for. And they're telling the IRS agent, think. I mean, they're doing the best they can, but they oftentimes don't want to engage you. That's more money again. That's more time. So they're out to be frugal here, and that's what happens sometimes. I'll say most of the time. And other times they're going to contact you and say, hey, we need something from you. All I need is this. You want me to come and talk with the IRS too? Nope. All I need is just give me that. Just give me that thing and I'll take that. And I will defend you in front of the IRS. That's your typical exam. If the case is unagreed, it goes to appeals. Their job is to settle the case based on the hazards of litigation. But this is a factual issue. Valuation is a factual issue. We're not talking about legal elements here associated with the return. That's something the taxpayer's attorney can address, legal issues. But on the factual issue, that's just trying to see if we can settle this based on the facts up at appeals. And about 85% of those end up being agreed. So your chances now are pretty slim. It's unagreed and going to counsel. And then if it goes to counsel, about 90% of those get settled before you go to court. So the ones that get to court, you're getting to a very small percentage based on what started off on exam. You've had three different slices, about 85, 90% being removed each time before it finally gets to court.